On the 15-minute time frame, this is going to give me all of the salient points of liquidity that I believe is going to be pertinent to the session that I'm going to trade or about to trade. And it also will have the built-in advantage of showing me the daily levels that I'd be interested in if I'm going to trade the full daily range. If I want to get the lion's portion of that full daily range, whether it be an up day or a down day, I can determine those points of liquidity on the 15-minute time frame. And I can also see all of the pertinent imbalances. We start the day at midnight, New York local time. That's the beginning of the new day. What does the London session do between 2 o'clock and 5 o'clock in the morning? What's the market do? It drops. This here is a Judas swing. A Judas swing is a fake price run for the express purposes of taking traders out of potentially profitable traders, position being long in this case, or to put them into the opposite direction, because there's always going to be traders out there that trade a breakout. The idea of focusing on a bias that is bullish on the daily chart, weekly chart, and monthly chart, we're expecting higher prices. So because of that, in my mind, I want to see what price does between midnight going down into 2 o'clock. Below that low is going to be what? Sell stops. Someone's going long there. So if we're bullish and we see that they did in fact take out traders that had stops below here at a time of day when it creates the high or low of the day, not all the time, most time. Now, because it does that very thing here, right at 3:30, and that's the low of the day. When it creates that low, we want to see some kind of displacement to the upside. Because if it does do that, that's indicating the algorithm is flashing like a billboard sign. It's going to go up now. So focus on seeking a premium price. So what is a premium price? It's going to be a short-term high and or a fair value gap above market price. Between this low here to this candle here, those are the range extremes that you're annotating. So down here when it hit the stops, first thing in my mind is, okay, how do we trade after that? And it should go into this gap here. Does it do that? Absolutely it does. Then it creates what? Another gap here. While I'm looking at price action in response to this area here, I'm also now measuring the willingness to see price find more support in this fair value gap. But when price starts to run up in here, it goes into this area here and just comes into the high of that candle right there. But the market rallies up and it leaves this imbalance. I'm looking at how this offered buy-side imbalance. It's inefficient in the scope that it is not offered enough opportunity for people to sell. It's moved one-sidedly on this time frame, the 15-minute time frame. So I'm anticipating price to want to do what? Offer price on the downside or offer it through sell-side delivery. This is buy-side delivery when price is expanding higher. Since I've seen it price drop down here and I'm bullish longer term, I anticipate this as a stop run. I don't need to buy down here. So it goes down here to take the stops on a day when we're bullish. Does the market immediately react by going higher after it goes below that low? Yes, it does. And also notice where the bodies are. See, the wicks they're trading down and past that low. That's the damage. You see where the close of this candle is here? Yes, this candle went all the way down there, but then closed right there. And then this candle opened, went all the way down here, past that low again, and then closed right there. And then we opened on this candle and tore off. That to me, listen folks, listen, how do I know when to trust a fair value gap? Well, first I have to have a bias, okay? Am I bullish or bearish? Because the narrative is going to build the idea of whether or not I'm going to be bullish or bearish. The bias cannot be derived until you at least confer with what the present narrative is. The market is long-term bullish. We're at all-time highs. Avoid trying to pick top. But the body's respecting the fact that it didn't close below that low. That tells me that this was a stop rate. So what does that really answer? Well, it answers, how do you know it's going to not go through that low and keep on going? I don't know in the first candle. I want to wait and see when it closes. It closes here. Then I want to see the next candle. What does it do? Does a little movement below that, but then the body stops there. What is that? That candle's closed right there. What is that? That's a swing low at a time when I'm bullish, at a time of the day when it creates the low of the day. If I'm bullish, it's knocked out traders that are long that had sell stops below that. So we crossed all boxes off that this is a high probability reversal in a day that's likely to go higher. So that right there is my first indication that that's a very high probability reversal point. You wait for the next candle. Does it create a swing low? Yes. That's also part of Power 3. It'll be in the book. Trust me. Oh, you're a tease, ICT. Well, I got to do it somehow, right? I got to get y'all worked up. So when I see that in price action, it gives me confidence to trust that was a rate on sell side below that low here. And then the highest probability trade is to wait to see if there's displacement. I'm going to wait for this right here. I want to see it dig up into Remember, this is the sell side imbalance, buy side inefficiency between that candle's low and that candle's high. I want to see it run up into these extremes from here to here. I want to see how it trades there. Does it trade all the way up to and close above halfway? Here's 50% of it. Does it close above that? Yes. So what does that tell me algorithmically? That it's going to use this imbalance here, okay? It's going to use that as a draw on liquidity. And now I want to see it do what? Work its way back down into this gap from this candle's high and that candle's low. This gap right here, I'm only going to refer to it in terms of its consequent encroachment, which is the midpoint of that gap, the 50%. And I would use that on a lower time frame chart to see if it's going to offer me an opportunity to go long. But now we're back into this discussion right here. So this becomes my primary focus when price shows you this displacement to the upside, and then you wait patiently for it to trade right back down into this candlestick's movement higher. The market will want to offer down close or down expansion candles, which is sell side delivery. It really means simply this. The market moved up right here, one candle. So it first started off real quick right here. So it wants to come right back down. And what that does is it affords smart money to now enter, to get long, accumulate long positions. Where would they buy? If you look at the high to the low, here's the midpoint of that big up close candle. We went past it, yes. But look at where the bodies are closing. Are they closing at or below that candlestick's high? No. Did we trade to that candle and through it? Yes, because we allow the wicks to do that. So when you're using stop losses, I'm looking at where those wicks have done the damage prior to my entry or before I move my stop loss. And because I know I see damage was done here, and I know that it can overshoot this a little bit. Okay, so if I was long down here, my stop loss wouldn't be jammed up underneath these bodies, because if it was, I would have been stopped out prematurely. So the fact that these candles are closing above the high of that candle, which makes this a buy side imbalance, sell side inefficiency fair value gap, trading down to that inefficiency, and these candles bodies not closing at or below tells me that we're really going to move higher and attack at the very minimum these relative equal highs.